In today's video, we're going to be going over Power of 3 and how to implement it to increase your trading accuracy. Power of 3 is very important because it will help you understand what direction to trade in. This is leading on from our daily bias video, and you're going to be using Power of 3 with your daily bias to form an accurate trading direction. Every day you should be going in the market with an established daily bias, an idea behind the Power of 3 that's going to occur. And then you should be looking for your setups where you can implement your own concepts. So in Power of 3, we have three main stages. The first stage is accumulation. So when accumulation is occurring, that's normally when the market is consolidating. Now, consolidation happens when the market is accumulating to go either long or short. So it's building up liquidity on either side of the market, so it can then take that liquidity and then create a move for the day. So the second stage in Power of 3 is manipulation. Now, manipulation is often the liquidity grab, the liquidity sweep. So this is basically the fake move / the Judas swing. This is there to induce traders into a false trading direction. So traders get involved in the wrong direction of the market and then they get taken out. So let's say the market is trending down. We have an accumulation phase, and then the market rapidly impulses to the upside, taking liquidity to the top side. And now traders who don't have a clear idea of bias and direction, and they're looking at those lower time frames, they will feel the market is going bullish. It's turning bullish. They will enter longs, and then they'll get taken out because that was the fake move. It wasn't the actual move for the day. And then they will be left scratching their heads. The third stage of Power of 3 is distribution. Now, distribution is the real move of the day. The market, after accumulating and manipulating, it will distribute to the actual direction it intended to. Now here we have a candlestick and we have a bar. Now this bar is representing this candlestick. So let's imagine this as a daily candle and this is a daily bar. We have the open, the high, the close, and the low. Okay, simple stuff. Now from the open to the high, this is the opening range. Your sell setups will be forming in this range from the open of the candle to the high of the candle. That is your opening range, and that's where you'll be finding your sell setups if you are on a bearish bias. In the opening range, so from the open to the high, we are accumulating for shorts, and we have a fake move, which is the Judas swing to the upside, and then we'll have the main distribution to the downside, and then the candle will close for the day. So our accumulation and our manipulation will happen all from the open to the high of the candle, and then finally our distribution is the real move to the downside. Okay, I want to show you this in theory before I show you on the actual chart. So let's look at this few lines I've scribbled on my chart. Firstly, I want you to try and identify where accumulation, manipulation, and distribution is occurring. Pause the video and try to see where you can spot it. I'm going to play the next slide and I'm show you on the chart. There we go. So here, the market is consolidating. We have accumulation. It's building liquidity to the top side and the downside. Then we have an impulse to the upside, which is manipulation. Yeah, and then we have distribution, which is the real move of the day. You see, the market is consolidates, moves up. Traders are tricked into thinking we're bullish. They enter longs. And then we have the real move, the distribution. Now, this is in a sense, we're in a bearish market. So you identify we're in a bearish market. Market's trending down, consolidate, fake move, distribution. Simple stuff. I'm going to take you to an actual chart now and show you in actual price action how this will occur. So here, let's look at the daily chart on S&P. What do we have here? We're in a downtrend. We make a swing low, we come up, the market rebalances some inefficiencies, and then we come down, and then we leave a fair value gap. Right? Simple stuff. So we have sell side liquidity, we have a fair value gap, and we're in a downtrend. Now you can identify a daily bias before the next candle plays. We can kind of have in our mind what is going to happen in the next candle. What were we expecting to see? The market is bearish. It's just rebalanced some price action from previous days, and we've left a fair value gap with a low here. What do you think is going to happen in the next candle? If you established your daily bias and you implemented power of 3 correctly, you would have caught this nice distribution to the downside. So here from the open to the high of the candle, that's our opening range. The market accumulated, it manipulated, made a fake move of the day, and then it distributed to the downside, taking out sell side liquidity from a previous swing low. All right, so if we look at that daily chart or that daily candle we saw on the lower time frames, this is the hour chart. Let's see what actually happened for that distribution to occur and how you could have caught that move. So this is the same daily fair value gap that we saw. I'm going to leave this here so you can reference it. And this is the same swing low from the daily chart where sell side liquidity was residing. All right, so first we want to label our midnight opening price, which I have done here. So New York time, 12 o'clock. When this candle opens, that is our midnight opening price for the day. And this to the high will be our opening range. This is where we'll catch our sell setup for this day. Now, this is the hourly chart. I want you to identify where the consolidation is happening. We were consolidating for a previous amount of days, but if we're looking only at today, we can see we consolidated here. This was our consolidation here. And then we had our rally to the upside. That is our manipulation. We took buy side and we came into our daily fair value gap. And then what do we have after that? The main move of the day, i.e. our distribution occurring. Simple. Accumulation, manipulation, our fake move, rally to the upside, inducing people into thinking the market is bullish. And then we had our actual move, which is the distribution to the downside. See how we're pairing our daily bias with power of 3. Our daily bias, we were bearish. We had a daily fair value gap. We had a swing low we wanted to target. And you can see it all played out with our power of 3. We accumulated. We had a fake move taking buy side into a daily fair value gap and then distributing as a main move to the downside. All right, so now dropping down to the 5-minute time frame, you can see this much more clearly. So we had our midnight open price here labeled, and these two orange lines are representing the daily fair value gap. We can see here from when midnight opened, we had consolidation in the market. Yeah, consolidating. This is our accumulation. And then what do we have? We had a rally to the upside, taking out buy side liquidity from all this accumulation prior, which is what? Our fake move, our manipulation. We had a manipulation from the composite man, induce buyers to thinking we're in a rally to the upside and the market is turning bullish. In the eyes of those traders who don't have a good daily bias established and they don't have an idea about power of 3 and they don't know how the market actually works and they're only stuck looking at the lower time frame, gambling the money away, they're going to see this rally to the upside. They're going to see this manipulation and take it as the market is turning bullish and they're going to try get into longs. And then what occurs after that is distribution, because this was the fake move. You don't want to be trading this. You don't want to be catching this fake move. You want to be waiting patiently on the sidelines, thinking in your head, okay, so this is a rally to the upside. We're taking buy side. We're tapping into a daily fair value gap. My bias is bearish. So I'm seeing this as a fake move. I'm seeing this as a manipulation from the composite man. And I'm going to wait for the actual main distribution so I can get involved for the main move of the day and get involved in sells. That is what you want to be thinking. So you can see here, accumulation, manipulation, and distribution. Now, how could you have got in this move and caught the distribution to the downside? So what you would have done was establish your daily bias, which was bearish. You would have saw this manipulation coming into the daily fair value gap. It made this high, it broke down, and it broke this low. After that, you would have had your midnight opening price here, which is related to the New York time zone. Midnight opening price from here to the high of the day. that is your opening range, and you'll be looking inside this area for your sell setups. There's multiple fair value gaps here, breaker blocks, order blocks. You could have taken any, whatever your ideal entry method is, you could have executed it here. And as you see, in our opening range from the midnight opening price to the high, the market gave many opportunities to enter. But after we broke down, traded below that, you didn't really have much opportunity to get involved. It just rapidly melted down and took the sell side liquidity. So after this opportunity from here in this opening range was missed, it was very unlikely for you to get involved in a sell setup. But this is how it works. The market will give you an opportunity in the opening range. After that, if it has a goal in mind, it will just break down and it will not give you a chance to enter. If you did enter here, you would be gambling, but you don't want to chase price. You want to get involved at the right time. Time before price is a very important thing. You always want to look at time before you look at price. Time is constant, price is always changing. It always goes from 12 to 12. It always goes from 1 o'clock to 1 o'clock. Price is always changing. Time is a constant. You always want to be taking time into account before you take price into account. Alright guys, that's basically it for today. I've explained Power of 3. If you have any questions at all, please drop a message in my Discord. I'll have a link in the description for that, or you just drop a comment. And yeah, like, subscribe, do all of that. And yeah, I'll see you next time.